So you take a borrower that took out a home loan in 2007 at the peak of the market. Housing didn't trough until early 2012. Many folks think that the housing market blew up in 2009. Well, it took another 3 years for housing to bottom out. So these borrowers that took out a home loan at the top, over the next 3 to 5 years, they had upwards of negative 40% equity in their home. They were grossly underwater. They continued to make payments to get back up to even, which took them another 4 to 5 years. They survived COVID. They continue to make payments. And now they've been in their homes for upwards of 20 years. So when we look at that particular borrower who's lived by their contract, has attained a tremendous amount of home equity, there's little likelihood that they would actually default on that loan. And the likelihood of them prepaying that loan or moving at some point increases as they build equity. So you take that borrower that took out a loan 15 plus years ago. They took out a loan at about a 5% coupon. Their housing value dropped over the next 5 years, so they could not refinance. It took them another 5 years till about 2017 just to get back to where they were when they took that mortgage out. And they've only been in the money to refinance really since COVID, right? So they're making $1,400, $1,500 a month payments. They're fixed. They've been in their home for the last 15 plus years. At that point, there's not a huge reason for them to refinance. They may not want to take on more debt. They don't want to deal with the hassle or the cost of refinancing. And so they're stuck. And for better or worse, that helps us as they continue to make those payments. But as they grow equity here and their children may be going off to college or having grandchildren, there's a lot more likelihood for them to refinance here.